$50 billion. That's how much money vanished in what prosecutors called the most sophisticated Ponzi scheme in American history. And here's the part that'll blow your mind. Harvard University, one of the smartest institutions on the planet, handed over hundreds of millions without asking the right questions. I'm going to show you exactly how one man fooled Nobel Prize winners, Ivy League endowments, and billionaire investors for nearly 2 decades. And by the end of this video, you'll understand why the warning signs were there all along. But first, you need to know how someone becomes trusted enough to steal $50 billion without anyone noticing. Quick note before we dive in. This is educational content, not financial advice. Always consult professionals for your specific situation. Now let's talk about trust, because that's what this whole story is really about. December 2008. The financial world is collapsing. Lehman Brothers just went bankrupt. AIG needed a government bailout. Everyone's losing money except one man. His investors, they're getting steady returns, 8 to 12% annually, like clockwork, for 15 years straight. While the stock market crashes 40%, his clients are sitting pretty with positive returns. Sounds too good to be true, right? Look at this comparison. The red line shows the stock market during the 2008 crisis, dropping like a rock. The blue line represents those impossibly steady returns that should have raised red flags everywhere. But here's what makes this different from every other Ponzi scheme you've heard about. This wasn't some guy in a cheap suit selling swampland in Florida. This was a former chairman of NASDAQ, a man who sat on the board of the Securities Industry Association, someone who literally helped write the rules for Wall Street. His name was Bernard Madoff. And if you think you would have spotted the scam, you're wrong, because some of the most brilliant financial minds in the world didn't see it either. So how does someone pull this off? How do you convince Harvard, Yale, wealthy celebrities, European banks, and sophisticated hedge funds to hand over their life savings? You don't start with a lie. You start with legitimacy. And that's the terrifying part. Madoff didn't wake up one day and decide to steal $50 billion. He built a real business first. In the 1960s, he started a legitimate market-making firm. This is important, legitimate. He actually traded stocks. He made real money. He became respected. By the 1980s, his firm was handling 5% of all trading volume on the New York Stock Exchange. This wasn't a con man. This was a pillar of Wall Street. He wore expensive suits, belonged to exclusive country clubs, donated to charities, sat on nonprofit boards. He looked exactly like what you'd expect success to look like. And that's the trap, isn't it? We trust success. We trust credentials. We trust people who look the part. But here's what Harvard and all those other institutions missed. They never actually verified what was happening behind the curtain. They trusted the reputation instead of doing the math. Now, Madoff's legitimate trading business was on the 19th floor of his New York office building. Nothing suspicious there. Computers, traders, all the normal Wall Street stuff. But there was another operation. The 17th floor. That's where the investment advisory business ran, the one that promised those steady returns, and almost nobody was allowed down there. When federal agents finally raided that 17th floor in December 2008, you know what they found? Not sophisticated trading algorithms, not complex financial instruments, just a handful of employees manually creating fake trading statements on old computers. $50 billion in fake wealth generated by basically typing numbers into spreadsheets. But here's what the experts and the insiders won't tell you. There were people who knew. There were whistleblowers. There were analysts who did the math and realized it was impossible. They were ignored. And that's the part of this story that should terrify you. All right, let's break down exactly how this scheme worked, because understanding the mechanism is crucial. First, you need to understand what a Ponzi scheme actually is. It's named after Charles Ponzi, who ran a similar scam in the 1920s. The basic concept is simple. You promise investors high returns, but instead of actually investing their money and generating profits, you just use money from new investors to pay the old investors. It's like a financial pyramid that only works as long as new money keeps flowing in. Now, here's how Madoff's version was different and why it lasted so long. First, he didn't promise crazy returns. Some Ponzi schemes promise 20, 30, even 50% returns. Madoff promised 10 to 12% annually. That's good, but not suspiciously good. It's exactly what a competent hedge fund manager might deliver. Second, he was selective about who he let invest. This is counterintuitive, right? Most scammers want as many victims as possible, but Madoff would actually turn people away. He'd make it seem exclusive, like you needed connections just to get in. This created enormous demand. People were begging to invest with him. Imagine you're trying to get into the hottest restaurant in New York. There's a 6-month waiting list. The owner is picky about reservations. That exclusivity makes you want it more, doesn't it? That's exactly what Madoff did with investments. He created artificial scarcity. Third, he had what's called a feeder system. He didn't deal directly with most individual investors. Instead, he worked through middlemen called feeder funds. These were investment firms that pooled money from multiple clients and then invested it all with Madoff. So if you were a regular person, you couldn't just call Madoff and hand him a check. You had to go through one of these feeder funds, and they took their own cut of your money as management fees. Now here's where it gets really clever. Madoff claimed he was using something called a split strike conversion strategy. Sounds complicated, right? That's the point. It's a real strategy that involves buying stocks and then using options contracts to limit your downside risk while capping your upside potential. In theory, this could produce steady, moderate returns with low volatility, exactly what Madoff was delivering. But here's the problem. The math doesn't work at scale. This diagram shows how the strategy theoretically works. You buy stocks, you protect against losses with put options, and you sell call options to generate income. It creates this predictable profit zone. But several financial analysts calculated that to execute this strategy with the amount of money Madoff claimed to be managing, he would have needed to trade more options contracts than actually existed in the entire market. The Chicago Board Options Exchange didn't have enough volume. It was mathematically impossible. A guy named Harry Markopolos figured this out in 1999. He literally did the calculations and realized Madoff had to be running a Ponzi scheme. He reported it to the SEC, the Securities and Exchange Commission. Not once, not twice, 5 times over 9 years. He handed them a detailed report titled, "The World's Largest Hedge Fund is a Fraud." And they did nothing. Why? Because Madoff had credibility. He was a former NASDAQ chairman. He had relationships with SEC officials. Some regulators who were supposed to be investigating him were literally socializing with him at industry events. The SEC conducted investigations in 1992, 1999, 2005, and 2007. Each time, they found nothing wrong. Or rather, they didn't look hard enough. In one investigation, they literally asked Madoff if he was running a Ponzi scheme, and he said no, so they closed the case. That's not an exaggeration. That actually happened. Now here's where it gets even more disturbing. Let's talk about the victims, because the scale of this fraud is almost incomprehensible. Madoff didn't just target wealthy individuals. He went after charitable foundations, university endowments, pension funds, and even Holocaust survivors. According to court documents, there were approximately 4,800 direct and indirect victims. The total amount of money that investors thought they had, based on their account statements, was $65 billion. The actual amount of money that went into the scheme was about $17 billion. And when everything collapsed, there was less than $1 billion left. Here's what actually happened to some of these victims. The P. Cower Foundation, a charitable organization, had invested $7 billion with Madoff. It was forced to shut down completely. Yeshiva University lost $110 million. The Elie Wiesel Foundation for Humanity, founded by the Holocaust survivor and Nobel Peace Prize winner, lost $15 million, basically its entire endowment. Individual retirees lost their life savings. One man, Thierry de la Villouche, a French aristocrat who had invested his clients' money with Madoff, took his own life 2 weeks after the fraud was revealed. The human cost was devastating. But the most shocking part? The signs were everywhere, and institutional investors ignored them. I'll explain what I mean in just a moment, but first you need to understand how these supposedly sophisticated investors conducted their due diligence, or rather, how they didn't. According to investigators, many feeder funds never actually verified that Madoff was making the trades he claimed. They just trusted the statements he sent them. Some feeder funds were making millions in fees, so they had a financial incentive not to ask too many questions. One feeder fund, Fairfield Greenwich Group, was collecting over $300 million annually in fees for basically doing nothing except routing money to Madoff. They had a legal responsibility to verify the investments, but documents show they never did comprehensive due diligence. Here's what the timeline actually looked like. In the 1960s, Madoff starts his legitimate broker-dealer business. In the 1970s, he quietly begins the investment advisory operation that would become the Ponzi scheme. Throughout the 1980s and 1990s, the scheme grows slowly but steadily. He's careful. He pays out returns consistently. He builds trust. After the dot-com crash in 2000, when many investors lost fortunes, Madoff's stable returns looked even more attractive. Money poured in. By 2005, he was managing somewhere between $50 and $65 billion, though nobody knows the exact figure because his record-keeping was deliberately chaotic. The scheme finally collapsed because of the 2008 financial crisis, but not in the way you might think. Madoff didn't get caught, he turned himself in. In December 2008, as the markets were crashing, many of his investors needed to withdraw money. They were facing their own financial problems and needed liquidity. Madoff couldn't meet the redemption requests because the money wasn't there. It had never been there. On December 10, 2008, he confessed to his sons that the investment advisory business was, quote, one big lie. His sons reported him to federal authorities. The next day, FBI agents arrested him at his Manhattan apartment. Here's what the investigation revealed. Madoff had been keeping two sets of books. One showed the fake profitable trades. The other tracked the actual cash flow in and out of the scheme. He had a small team of employees who were in on it, creating fraudulent documents. They would backdate trades to match whatever returns Madoff had promised. If the stock market went up, they'd show that Madoff had bought stocks. If it went down, they'd show he'd sold and gone to cash. It was all fabricated. The documents show Madoff hadn't made a legitimate investment trade for the advisory clients in decades. Every single statement was fiction. So what does this mean for you? Why should you care about a fraud that happened over 15 years ago? Because the systemic problems that allowed it to happen still exist today. Here's what this case reveals about how our financial system actually works. First, regulatory capture is real. The SEC was supposed to protect investors, but it had deep ties to the industry it was regulating. Former SEC officials would go work for Wall Street firms. Wall Street executives would take temporary government jobs at the SEC. This revolving door created conflicts of interest. So what does this mean for you? Why should you care about a fraud that happened over 15 years ago? Because the systemic problems that allowed it to happen still exist today. Here's what this case reveals about how our financial system actually works. First, regulatory capture is real. The SEC was supposed to protect investors, but it had deep ties to the industry it was regulating. Former SEC officials would go work for Wall Street firms. Wall Street executives would take temporary government jobs at the SEC. This revolving door created conflicts of interest. Your retirement account, your pension fund, your savings, they're all managed by people operating in this same system. Second, the too big to fail mentality extends beyond banks. Madoff's firm was considered so important to the functioning of NASDAQ that regulators were hesitant to scrutinize it too closely. They didn't want to destabilize the market, so they gave him the benefit of the doubt over and over again. Third, the illusion of safety from credentials and reputation. Harvard's endowment managers, Nobel Prize winning economists, experienced hedge fund operators. They all got fooled because they trusted pedigree over evidence. If you have money in investment funds today, here's what you should be thinking about. Can you actually verify where your money is? Do you receive statements from an independent custodian, not just from the investment manager? Are the returns you're getting consistent with market conditions, or are they suspiciously smooth? One of the biggest red flags with Madoff was the consistency. Real investments fluctuate. If someone is delivering positive returns month after month, regardless of market conditions, that should raise questions. The Madoff case also exposed the problem with feeder funds and layers of intermediaries. If you're investing through a fund of funds, or any structure where multiple parties are taking fees, you need to understand that each layer reduces oversight and accountability. Your money might be 4 or 5 steps removed from the actual investments, and nobody in that chain is doing comprehensive verification. They're all just trusting the next person down the line. Since Madoff, there have been more Ponzi schemes, smaller in scale, but using similar tactics. In 2020, there was a crypto Ponzi scheme that defrauded investors of billions. In 2022, another investment advisor was arrested for running a scheme that lasted over a decade. The pattern repeats because the fundamental vulnerabilities in the system haven't been fixed. Regulators are still underfunded and overwhelmed. The SEC receives thousands of tips every year and can only investigate a fraction of them. If someone is determined to commit fraud and sophisticated enough to hide it, they can operate for years before getting caught. Looking ahead, the rise of complex financial products, cryptocurrency, and algorithmic trading creates new opportunities for fraud. It's harder than ever for average investors to verify what's actually happening with their money. That's not a reason to avoid investing, it's a reason to be more diligent. Ask questions, demand transparency. Don't invest in anything you don't understand, no matter how prestigious the person managing it seems to be. So what can you actually do to protect yourself? First, understand the difference between custody and management. Your investment manager should not also be the custodian of your assets. The money should be held by an independent third party, like a major bank or established brokerage firm. You should receive statements directly from that custodian, not just from your advisor. This is crucial. Madoff was able to create fake statements because he controlled both the management and the custody second. Be skeptical of exclusivity. If someone makes it seem like you're lucky to invest with them, if they're selective about who they accept, that's not necessarily a sign of quality. It might be a manipulation tactic. Legitimate investment managers want qualified clients, but they don't create artificial scarcity. Third, verify credentials independently. Don't just accept what someone tells you about their background. The SEC has a public database called BrokerCheck where you can look up any investment advisor's history, including any disciplinary actions or complaints. Fourth, understand the fee structure completely. How is your advisor getting paid? Are there multiple layers of fees? Who else is taking a cut? In the Madoff case, some feeder funds were collecting enormous fees while doing essentially no work. Those fees were coming out of investor returns. If you can't get a clear, simple explanation of all the costs involved, that's a red flag. Fifth, ask how the investment strategy makes money. If the explanation involves complex jargon and you walk away confused, don't invest. A legitimate strategy can be explained in plain English. Madoff's split strike conversion sounded sophisticated, but when experts analyzed it, it didn't make mathematical sense. On a larger scale, we need regulatory reform. The SEC needs more funding and more authority to conduct surprise audits. There should be mandatory independent verification of investment holdings. The revolving door between Wall Street and regulatory agencies needs to be addressed with stricter ethics rules. Some of these changes have happened since Madoff, but not enough. Investor advocacy groups are pushing for stronger protections, and you can support those efforts by staying informed and contacting your representatives when financial reform legislation comes up. Here's the final thing you need to understand. The Madoff fraud wasn't just about one criminal. It was a systemic failure involving regulators who didn't regulate, auditors who didn't audit, and investors who didn't verify. Everyone in that system had some responsibility, and everyone failed. The good news is that you have more power than you might think. By asking the right questions, demanding transparency, and refusing to invest in things you don't understand, you make it harder for fraud to succeed. Financial literacy is your best defense. So now you know how the biggest Ponzi scheme in history fooled Harvard, billionaires, and supposedly sophisticated investors. It happened because people trusted reputation over verification, because they didn't ask uncomfortable questions, and because the regulatory system failed at multiple levels. The question is, what would you have done differently if you were an investor in 2008? Would you have spotted the red flags, or would you have trusted the credentials like everyone else? Let me know what you think in the comments below. If you found this valuable, hit that like button and subscribe so you don't miss future videos where we break down complex financial stories. And if you want to understand how other major financial frauds happened and what warning signs to watch for, check out the video I'll link in the description about the Enron scandal. It's a completely different type of fraud, but the lessons are just as important. Thanks for watching, and remember, in finance, if something seems too good to be true, it probably is.